With the rising tensions in the world between the United States and China, but also of course Russia and Ukraine, people are flocking more and more towards a certain category of stocks, namely defense-oriented stocks. And the biggest player in the defense industry, apart of course from the national armies like the United States Army or the Chinese Army, the biggest private player in the defense sector is Lockheed Martin. Lockheed Martin is a aerospace, arms, defense and information security company located in Bethesda, Maryland. So let's have a quick look over at their financials. Let's see whether or not we think that Lockheed Martin right now is a good buy, and let's see whether or not we want to buy it and hold it for 10 years so we can outperform the market. So their revenue numbers show a 4% growth annually, which is definitely outpacing inflation here. Lockheed Martin also gets a lot of government contracts, so you can assume that the moment that tensions rise, that Lockheed Martin will get additional funding from the government. Compared to their revenue, their EBITDA has been growing by 6% annually, which means that their profit margins are increasing. 4% growth in revenue, 6% growth in EBITDA. If we have a quick look over at this growth, let's see, we take the EBITDA and we divide it by their revenue, and we do that for the last 10 years. We can see that their EBITDA profit margin was 12% in 2013, and they've remained stable at around the 15 to 16% mark here in the other 9 years of our 10-year history. Their debt level has been increasing by 10% every single year, but just looking at their EBITDA numbers, this seems like something they can easily afford. Excess cash on the balance sheet is always available as well. In case of a downturn, in case of a shortage of certain supplies, Lockheed Martin quickly has some excess cash in their war chest to solve most of their initial problems. Market cap, so this is the price in the open market itself, which has risen 10% annually for the past 10 years, which is definitely outperforming the market overall. Overall on the open market, we see an increase of around 6 to maybe 7%, but Lockheed Martin booked performances of 10% annually. Enterprise value is 10.5%, and this is because we also add the debt to the market cap and we subtract the cash, and this is how we get the enterprise value. Because of course debt and cash are part of the business and not a separate entity, so I like to combine these two metrics to give me a proper valuation of their enterprise. EV/EBITDA ratio. This is the multiple with which a company trades, and for Lockheed Martin it's been around the 12 times range here for the last 10 years. 2022 they saw a multiple increase to 14.5, which is definitely a lot higher than their 10-year history would indicate, but maybe this is because of the rising tensions and because people are flocking to Lockheed Martin expecting a higher return because defense may be more necessary here in the future. Net debt to EBITDA, like I mentioned, they are not leveraged in any way, shape or form. They have a debt of 15 billion with an EBITDA of 9.7. There is no risk of bankruptcy for Lockheed Martin whatsoever, so I think it's a fairly safe stock to hold. And there is little chance that you'll be wiped out completely. So let's have a look over at their cash flow statement. Their cash flow from operations has been increasing by 6% annually for the past 10 years. 4.5 billion in 2013, 7.8 billion in 2022, where we definitely saw a higher number in 2021, so I do expect them to also increase from 2022 onwards to kind of reach those numbers once again. Cash flow is growing in line with EBITDA, which is always very nice to see. Capital expenditure, so this is all the costs required to future-proof their business. Any additional acquisitions, any additional equipment that's required for them to keep on operating the way they currently are is included into capital expenditure. And we can see that their capital expenditure is growing a little bit faster than their cash flow, but because it's so marginally lower, it's not really a problem at all, and their profit margins are definitely very secure. The moment that we take the cash flow from operations and we subtract the capital expenditure, we get the free cash flow, and the free cash flow is basically your pro rata ownership of the company. This is all the money that's available to you as an equity owner at the end of the fiscal year. And Lockheed Martin can decide exactly how to use this cash. Of course, they can do additional acquisitions, they can buy back stock, they can issue a dividend, and they can also just buy back that debt. As we have seen from their balance sheet, there's not much debt to speak of, so I definitely don't think they'll be using it for that. No, they've been using their free cash flow to buy back shares consistently and also issue a dividend of around 2.5%, which is quite attractive, I think, for any investor, especially considering the fact that they're also actively buying back shares. They've been reducing their share count by 2% every single year, which means they're basically buying shares and ripping them up in your favor, increasing your percentage ownership of the company without you having to raise a finger to do so. Free cash flow per share is the amount of free cash flow divided by the amount of shares, and because their free cash flow is growing and the amount of shares are decreasing, of course this creates a hockey stick curve for your free cash flow per share and your returns as an individual investor. We see $11 here in 2013 and $23 in 2022. The price per share on the open market has been increasing by 13% for the last 10 years. $150 in 2013 and almost $500 here in 2022. Definitely a very attractive return, and this is not even including the dividends that Lockheed Martin has also paid over this 10-year time span. This is just looking at the price on the open market itself. And you may be wondering, why is the price per share different from the market cap? And this is because market cap is the price per share multiplied by the amount of shares outstanding. And because the amount of shares outstanding are decreasing, this means that the price per share must be higher compared to their overall market cap increase, because you have to balance the scales there. Free cash flow yield overall has an average 10-year average of about 5.6%, around 6% I would say to be a bit more conservative, where certain years like in 2018 they've definitely seen a way lower number. So let's try to forecast Lockheed Martin here into the future. So I'm going to take their 2022 EBITDA number and I'm going to grow this by 5% annually for the first 5 years and then 4% for the last 5 years. Of course, if the tensions around the world are increasing the way they have been for the past 2 years, I do think that Lockheed Martin could see a bigger increase in their EBITDA as they get more funding from the government and their services are required more all over the world. So I think if that does happen, and maybe many of the current investors are actually kind of counting on that to some degree, then I do expect their EBITDA growth to be a bit higher than the 5% that I gave them here, but I want to be a bit more conservative. Let's try to paint a rosy picture and say that World War III does not happen in the next 5 years, then I do not expect their EBITDA to grow all that much more than 5% and 4% for the last 5 years. I'm going to attach a 12 times multiple, which is their average multiple here for the past 10 years, and is definitely going to be coming down from their 2022 numbers. This then gives me an enterprise value of $181 billion, from which we then subtract the debt, we add the cash, and this gives us a market cap of 168 billion. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. This gives me an overall share price 10 years from now, so in 2032, of $637.10. And as always, for their free cash flow, I'm going to do a very similar thing. I'm going to grow it by 5% for the first 5 years and then 4% for the last 5 years. I'm going to attach a 6% free cash flow yield to it, which is about in line with the average numbers once again. And this gives me a stock price 10 years from now of $598.85. Looking at the open market itself, right now I can buy as many shares of Lockheed Martin as I want for $452. If I take both my projections, so the enterprise value as well as the free cash flow model, which are quite similar in number here, I get an average share price 10 years from now of $617.98, which gives me a compounding annual growth rate of 3.2% on the stock market alone. But the moment that we include the free cash flow that we can expect from Lockheed Martin as projected in our free cash flow model, I expect an IRR of 10.2%, which is very much performing in line with the overall market expectation. On average, the market returns about 10% annually, and I expect Lockheed Martin to do the same. So let's see what happens if the price goes up or comes down a little bit. So the moment that the price lowers by 30% to around the $330 range, which we have not seen for the last 4 years at the least, I expect an IRR of 16%, which I think is quite attractive for a stable, growing stock like Lockheed Martin. If the price goes up a little bit to the 600 range or even the 500 range, I expect an IRR well below market expectations, so then I expect Lockheed Martin to underperform the stock market, which is mostly due to the fact that I think right now with a multiple of 14.5, they are way above their average multiple, and I think the moment that global tensions will kind of reduce and dissipate, I I expect this multiple to come down again, which will of course then depress the stock price and therefore also depress your returns. So definitely keep that in mind. I think Lockheed Martin is very much being boosted right now because of the rising tensions. And the moment that these tensions go away, you can see a decrease in profitability from buying this stock. Of course, there's also always the ethical consideration. Do you want to invest in a weapons supplier and a private defense company? It's up to you. So thank you very much for watching. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio.